Coming up on Market to Market, farmers and ranchers watch record profits dwindle. Legal action shuts off the tap on new EPA water rules. And growing crops in a drought leaves some producers up in the air. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, August 28 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The stock market remained front and center this week, overshadowing otherwise positive economic news. According to the Commerce Department, new home sales rose 5.4% last month, recovering from a nearly 7% drop in June. Orders for durable goods, items expected to last at least 3 years, increased 2% in July, piggybacking on June's upswing. When big-ticket items like airliners are taken out of the mix, orders rose 0.6%. The Conference Board revealed this week consumer confidence grew to 101.5 in the 30-day period ending mid-August. The 12% surge was the best since January and attributed to a positive outlook on the job market. Despite the encouraging reports, weakness in the Chinese economy threw Wall Street over a cliff. The Dow Jones Industrial Average fell more than 1,000 points at the beginning of the week, straight into what is called a market correction. The Dow Jones, S&P 500, and NASDAQ indexes clawed their way back at the end of the week, but closed near levels seen 1 year ago. While investors on Wall Street are on the downside of an economic move, those in farm country have been experiencing losses for some time. Higher costs and lower returns are taking their toll, leaving fewer dollars in the pockets of U.S. farmers.
Farmers will make some money this year, just less of it, according to USDA projections. A glut of grain, milk, and hogs is driving the drop, as a reduction in demand is taking the price along for a ride. When you factor in an expected third largest corn and second largest soybean crop on record, market prices are likely to be below the cost of production. Net farm income is forecast to decline 36% to $58.3 billion, a decrease from last year's $91.1 billion and the lowest in 9 years. The profits come even as the drought grips the nation's west and a major outbreak of disease in the chicken and turkey sector have occurred this year. This is only 2 years removed from the highest income mark ever of $123.7 billion. The 2015 projection is off 53% from that record. Continued sliding grain prices were offset in 2014 by higher livestock prices. However, both are predicted to fall in 2015. Corn is forecast to be off 6%, while livestock is calculated down 9% year over year. Farm debt is estimated to rise 5.8% according to USDA. 6 years of higher land values have been good for owners who lease out their acres, but renters have seen profits erased with the increased fees. The losses at the farm gate have rippled through the agriculture economy. Deere & Company, the world's biggest farm equipment manufacturer, has cut its workforce by over 1,000 employees over the last year in reaction to the lack of demand for machinery. The Moline, Illinois-based company also reduced their earnings forecast last week by 5% to a still healthy $1.8 billion for their fiscal year ending in October.
Increased jurisdiction over waters of the United States went into effect late this week with 13 exceptions. A federal judge in North Dakota blocked the controversial measure in the states where attorneys general are suing the U.S. government. The temporary injunction, put in place with less than 24 hours to spare, stops the Environmental Protection Agency and the Army Corps of Engineers from extending their authority to more places where water runs or collects. Many of these streams and wetlands scheduled for closer scrutiny are bone dry due to multiple years of drought. While farmers and ranchers wait for a decision, some producers have stopped worrying about when and if any rain will fall. And as producer John Torpy found out last spring, one group of entrepreneurs has found a way to grow crops with a smaller footprint and fewer gallons of water, leaving the whole operation up in the air. Paul Yeager explains.
As California enters a record fourth consecutive year of drought, some worry the region's vegetable growing capabilities may be wilting, and entrepreneurs are turning to an innovative method of producing fresh, sustainable greens without soil. The Oklahoma landscape is dominated by oil pumping jacks and cattle. But in one area of Tulsa, a new type of greenhouse has sprung up. Part new business opportunity, part environmentally conscious philosophy, Scissortail Farms has embarked on a growing movement in the Sooner State.
So we realized that there was so much produce coming from the Southwest, and it was spending, time getting trucked or flown out to the markets that it eventually ended up in, and we wanted to, we saw an opportunity there to create something that would be closer to the market, and at the end of the day, be providing a better, fresher product.
At the beginning of the decade, Rob Walenta and John Sultan built a business plan for a local greenhouse, and their research led them to an innovative method of production called aeroponics.
Being able to provide a fresher, healthier product locally and year-round, when the market's so volatile in the Southwest based off environmental conditions or worker conditions, we have a setup where we can produce consistently throughout the year and offer the same price and the same quality in the middle of winter that we can in the summer.
The aeroponic process does not require soil. It's similar to hydroponics in that it relies heavily on nutrient-rich water. Scissortail Farms sprays an enriched mist over the exposed roots. But before any of that can happen, the seeds germinate in a mix of woven volcanic material.
Then within this substrate, you can see are individual little cubes. And once these grow to their height, we simply break these cubes off, and when they go outside, they fit in each one of the slots in the larger towers.
Once the plants have been moved, timers control the application of nutrient-enriched water designed for that specific plant. Scissortail Farms estimates that the growing process uses 1/10 of the water it would take to grow the same crop on a conventional farm.
Well, each one of these towers has these rings that interlock, and in the center they form a channel. So that channel runs all the way through from the top to the bottom, and at the base, in the reservoir of each one, is a submersible pump. And that pump sends the water through the channel to the top, where it collects, and then it drips back down over the roots that are suspended within the tower.
Although startup costs were steep, the folks at Scissortail Farms were willing to take the gamble, believing not in only the business itself, but in the support of a growing movement towards locally sourced foods. Local distributors are embracing that trend as well by delivering goods from Scissortail Farms to hospitals, grocery stores, schools, and numerous restaurants. While demand is somewhat elastic, it's not uncommon for the 37,000 square foot facility to produce 800 to 900 cases of leafy greens each week.
I mean, that's what John and Robbie try to do, but they try to gauge the supply and demand, and we try to do the best we can. But we're still fairly early on, so. And it's a big place, so we've got lots of room to try to make educated guesses.
Having just celebrated their first anniversary, Rob credits the farm's startup success to the friends and family who helped with the initial funding to get the operation off the ground.
We've got 1,368 of these towers, so we've got 62,000 plants growing at any given time just in the production area, and then about that many growing in the prop area as well. So having people here who know all the aspects of the business and are passionate about it, it's a huge relief for us to be able to go focus on some other things and know that everything's getting taken care of here.
Tall Grass Prairie Table in downtown Tulsa was one of Scissortail Farm's first customers, and the locally sourced restaurant quickly embraced aeroponics.
We tasted the product, it was beautiful, and immediately we took it on.
Tall Grass Prairie Table is a farm-to-fork restaurant with a menu that is built with 80 to 90% local ingredients. The owners work hand-in-hand with local farmers to ensure that products they purchase meet the quality they demand for their customers. For Chef Donaldson, one of the advantages of the product Scissortail Farms brings to the table is the ability for her to be a part of the growing process.
It's a really great feeling because I really get to own my plate. I'm not at the mercy of what may or may not be there. So if I do go to Rob and say, hey, this is the size that I want, this is the blend that I want, he's able to put that together, and it comes directly to us. So I do have a little bit more control instead of just saying, I'll have 3 cases of spring mix.
It takes significantly less time to grow produce aeroponically, and the method's precise control of the environment enables Scissortail Farms to deliver fresh produce year-round.
What's amazing about this is if someone comes to us in October and says, hey, I need 200 heads of a particular type of lettuce by January, I say no problem. And so that's what makes this remarkable is when it's snowing outside, when there's a blizzard outside, it's 72 degrees in here and we're growing heads of lettuce and it's fresh, it's picked that day. And you can't do that anywhere else.
For Scissortail Farms and its customers, success comes not only from technological advancements, but by working together to accelerate the move to locally grown foods.
The relationship that Rob and I have, I give him the opportunity to do what he's doing by giving his business money, and he gives me the opportunity to do what I'm doing by allowing me to take control of what I'm putting on my plate. And so it's a sustainable relationship between the two of us. It helps both of us monetarily, but it also helps us focus on a shared vision.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
Despite optimism over better export numbers, strengthening energy prices, and recovering equities, the grain markets finished lower. For the week, December wheat lost 20 cents. The nearby corn contract fell 2 cents. Soybean prices rallied after a 20-cent loss early in the week, with the nearby contract finishing only 4 cents lower. December meal prices went the same direction, dropping $1.90 per ton. In the softs, December cotton fell back after 2 weeks of gains, losing $3.91 per hundredweight. Over in the dairy parlor, September Class 3 milk futures declined 61 cents. The livestock sector reversed course this week as the October cattle contract rose 13 cents, October feeders gained nearly $3, and the October lean hog contract bumped up $3.61. In the currency markets, the U.S. dollar index gained 1.2%. Oil strengthened for the first time in several weeks, surging $4.77 per barrel. But prices are half of what they were 1 year ago. COMEX gold lost $25.60 per ounce, and the Goldman Sachs Commodity Index gained back all of last week's losses to settle at $366.25. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Thank you, Mike.
It was an eventful week, to say the least, in all the markets.
It really was. I mean, it started with the overnight session Sunday going into Monday. When we first had the news early Monday morning that China had devalued the yuan, even before anything opened, we knew things were going to get fun.
And fun is a trader's and an analyst's way of putting it.
Yeah.
Now, speaking of China devaluing the yuan, I want to jump into this wheat market first. Looking at the overall supply picture, still very, very bearish. What are you seeing with this market? Are we getting close here to finding a bottom?
Boy, I'd like to say yes. I'd like to say yes, but I can't. We saw all three markets, Chicago, Kansas City, and Minneapolis, go to new lows this past week. We've got a lot of volatility in the U.S. dollar index, and really of the grains, the wheat is the most susceptible to moves, or I should say most vulnerable to moves, counter moves in the dollar. So when you've got that going on, when you've got the supply situation, when you've got export demand that just really refuses to pick up, it's hard to say, wheat's going to find a bottom in here. But I've also been around the wheat market long enough to know that just when it looks the blackest, just when it looks like there's absolutely no hope whatsoever, it turns around. For what reason this time, I have no idea. But there is starting to get this to be this sense that we've beaten this market down a long ways. If it's going to recover, it's going to have to be soon. It's going to have to find some buying interest soon, or it could become a real train wreck.
Okay, now speaking as we look out longer term, we've got a question here from Facebook. Matt in Standish, Michigan wrote us, and we encourage all of you to check us out on Twitter or Facebook at Market to Market. And Matt's question is, with low soybean prices this fall, do you expect to see higher wheat acres? And if so, when should we look for sales of both old and new crop winter wheat?
It's wheat always gets thrown into the mix. There's just, from what I hear from the industry, there's just no money in wheat. So, even with the lower soybean prices, even with lower corn prices, I don't know that we're going to see a huge switch over to wheat. We haven't seen it in the past. Yeah, things are getting a little bit drastic right now, but let's look where our demand is. Our demand is with corn and with soybeans, and the demand's not there for wheat. So if we plant more wheat acres, that's going to create even more of a problem. There's plenty of wheat worldwide, and we don't need global ending stocks climbing to 40, 45% or greater. So I don't know that we will see more wheat acres in 2000 and whatever year we're coming up on, 2016. I'm losing track of years. I wouldn't imagine that we're going to see much increase.
Okay. So as we look at this wheat market, we're really going to need a corn rally, something to that effect, to give this thing some legs.
We're going to have to see a corn rally. We're going to have to see the long-term trend in the U.S. dollar index, the downtrend play out. Just like with the stock market, it's like with the Dow and the global stock markets. U.S. dollar index was incredibly volatile this last week. And on Monday, it certainly looked like that collapse was finally coming. It wasn't enough to support the grains, but by the end of the week, it had bounced back. If we see the dollar index actually start to trend lower, and if there's actual weather problems, say in Argentina or parts of Europe and other things, maybe at some point we actually start to see some demand come back to the United States. But all of these things have to happen. And right now we're waiting for the first one.
Okay.
And so it's going to be very difficult. It's going to need help from corn. It's going to need help from a lot of outside markets.
Okay, well, let's jump into this corn market. 2 cents down on the week after and corn was actually relatively stable given all the other markets this week. Tell us a little bit about what your thoughts are here as we roll into this new crop. What should producers be doing today looking at this harvest?
I'm going to go down with this idea. It's probably going to be written on my headstone someday, is that I'm probably the last remaining corn market bull still. Why? I can't point to why. I don't think we've got the yield. I guess we don't have the yield that everyone's talking about. Maybe it's there. Maybe I'm going to be surprised and the yield is actually there. The market did hold together relatively well this week. Is it the calm before the storm? We saw wheat go to new lows. We saw all this volatility in the stock market. We saw the volatility in the U.S. dollar index. We saw soybeans go to new lows. We have all these things, and really corn's the only one still standing. It's still holding in there. But how long can that last? We're going to have to see some demand start to pick up. As we come to the end of the 2014-15 marketing year, exports are going to come up short of what was projected. Those are going to be carried over, or we're going to see larger ending stocks now carried over into the 15-16 marketing year. So that's going to offset some of the potential decrease in production that's expected to come down the road if USDA starts to whittle back its yield and production numbers a bit. So it's going to be tough. Corn held steady. But we need to see more of that. We need to see something better out of the corn market if it's actually going to follow through on its long-term patterns and actually start to move higher.
Now, the last time we had you on the program, Darin, you were pretty bullish to the tune of $4.50 corn next spring. Storage was going to pay for itself.
Yep.
Do you still think that is a potential, or are we getting farther and farther away from that $4.50 in the spring?
Both. We're getting further and further away. There's no denying that. We're just slowly eroding this market. I still think we can get there.
Okay.
I still think demand is understated right now. New crop demand is understated. And I think production and supplies are overstated. Now, what possible signals on the markets are telling me this? There are very few at this point. The future spreads holding in there, but they're nothing fantastic. I do still think this market's going to come back around.
Put it in the bin.
But we have to be very careful with it.
Okay.
Because again, we've seen all these other markets go to new lows. It could happen to corn at any time. I mean, it could all of a sudden, we could come in Monday, another piece of news like what we saw this past Monday, and we're talking about a completely different scenario.
Okay. Well, speaking of new lows, let's move down to the soybean market. A volatile week in soybeans, particularly as we look at China. That's where this crisis in the equities arose. How worried are you about this weakening Chinese economy as concerns soybean exports?
It's interesting to me. And I think it really paints a clear picture of the type of market dynamics that we have in play. Have the fundamentals of soybeans really changed that much? China is still going to buy. They have to buy soybeans. They have to buy them somewhere in the world. U.S. is going to supply its fair share of soybeans. But because the news is of China's economic problems, anything associated with China collapsed. All of the Asian stock markets fell. The U.S. stock markets fell. We saw we saw things play out in the currencies. The soy complex took a beating on Monday, but then it came back. And all over the rest of the week, we saw 3 separate instances where headlines came out that new sales were being made to unknown. Okay, unknown, even with its economic problems, is still buying soybeans. So I don't know that the market has changed as much fundamentally from the demand side as everyone's saying. Nevertheless, reality is reality. Market moved to a new low. Money continues to come out of soybeans. And as long as there's a perception of Chinese problems and this is going to change all of these things, soybeans are going to struggle.
Producer, hold as we get into harvest and hold as long as you can before making some sales, or what's your advice here?
There's very little carry in the soybean market right now. There's no, and this tells us 2 things. One, it tells us that really the market still has a bullish view of supply and demand, but it's not going to pay you. It wants the soybeans now. It's not guaranteeing anything out later. So it's almost, you bring them across, you sell them, and then you look at some sort of re-ownership strategy. I'm not a huge fan of that. I've never been a huge fan of that. But I still think at some point the soybean market's going to bottom out. If it doesn't, it's going to spell problems for markets that are tied to it. But I think it's going to bottom out, and I still think it has a chance to move higher long term.
Okay. All right. Well, now let's jump down into the livestock markets. We've got October live cattle trading relatively flat on the week. Again, it looks like we're just hanging in there with this beef market. Stronger GDP. Does that give you some hope for increasing consumption as more cattle come online?
It's possible. I mean, the spreads and the fundamentals haven't changed all that much in the cattle market. And you mentioned how there was very little change, and that's the beauty of a weekly close chart. There really wasn't. But to look back at the type of, just like with everything else, the incredible volatility we saw in live cattle, where they just collapsed early. I mean, everything fell apart on Monday and then had some more problems on Tuesday. It looked like the cattle market was really going to get battered, but it did come back. And so, it may try to build short term on that. We've got the possibility of a little bit of run coming into the market. This solid close that we saw on Friday could follow through into next week. So I wouldn't be overly surprised to see cash markets remain relatively, try to firm in here. Futures market move up a little bit. Demand stay solid here for another 30, 45 days, something like that. You talk about the GDP, some of these other economic indicators, long term, that should probably help with demand, but what we're really going to be looking at, our supply is going to continue to increase a little bit over time to offset that demand. And are we looking at a longer term problem?
Speaking of longer term problem, the feeder market, looking at the spreads out into the future, looks like they already anticipate that long term problem coming. What's the advice to producers looking at having some calves to market yearlings in the spring?
If we get what looks like to me maybe a short-term turn in the live and feeder cattle markets right now, I'd certainly use it to my advantage because I still see the long-term trends going down. I don't think we've bottomed these markets out long-term. Short-term, intermediate term, maybe we have. going to get a little bit of a rally here on the weekly charts, daily charts, and so on. Use those to our advantage. If we get the opportunity, we're going to want to make some sales out in the deferred contracts, lock in some prices, because this thing could turn around and start to fall again. If we see some sort of rally coming in the grains, if the U.S. dollar index falls, if economic data starts to turn south again, that's when I think the cattle industry could start to have some problems.
Okay. Now let's jump and look at this lean hog market, up 361 on the week. A lot of pigs out there, but demand must be staying relatively strong. From a chart perspective, where are we sitting today?
It's interesting that the hogs actually seemed to have turned, and are in the process of turning long term, more so than the cattle market. So I wasn't overly shocked at the activity, or I should say at the conclusion of this week when it comes to the lean hog market. The activity, like everything else, was very volatile, but it looks like we're building this base in here on the hog market now. So I wouldn't be as anxious to be making some deferred sales in hogs, but we do know the hogs can change their mind, in the flip of a coin. So it can come very quickly. But I would almost let the hog market run a little bit here, and let's see if we can't start to build some momentum, not just in short term, but maybe some longer term momentum as well.
Set that base in low 60s and then watch for it to climb from here.
I think so.
Are you looking at the mid 70s, mid 80s? What looks like a top to Darin?
If we can keep demand relatively firm, could we get back up into the 70s? Sure. Could we make a run at the 80s? A lot of things are going to have to happen before then. We're going to have to keep this demand solid. We're going to have to keep the cash market underneath things. So outside chance of getting that high.
All right. Well, Darin Newsom, thank you so much for joining us this week.
Thank you, Mike.
That wraps up this edition of Market to Market, but Darin and I will continue our discussion and answer some of your questions in the Market Plus segment available on our website. You'll also find audio podcasts of this discussion as well as streaming video of the program exclusively at that Market to Market website. You can also interact with us through our Twitter and Facebook feeds. And join us again when we'll explore how chicken broiler producers are preparing to combat avian flu. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.